All right, greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. And I'm also I also run a online options trading firm called Flip That Option. So if you're interested, definitely check out the website cubicleinvesting.com. Scroll down and you can actually watch the video, and you can actually potentially become a member of our Flip That Option community. All right, so today is it's May the 20th. It's 11:12 a.m. Eastern Standard Time. And for those who have been following me for quite some time, and also please subscribe and also like the video if you haven't already. If you haven't already subscribed, please subscribe. And also, if you find some value in this video, definitely like the video. Definitely would appreciate it. So for those who have been following me for quite some time, you know that before, so I primarily do SPX 0 DTE trades. However, before I look to put on a trade for the 0 DTE, I'm always looking for the SPX to make a 20-point move above or below the opening price. So now this morning, the opening price was 59.44, right? And so 20 points above that, 59.65 roughly. And 20 points below that is 59.25. And so unless the SPX moves 20 points above or below the opening price, I don't look to put on a trade, because there's not enough price action information, PAI, for me to determine which side of the trade I need to be on, whether it's going to be the call side or the put side, right? And so in normal market conditions, meaning that when the SPX, or when the VIX, when the VIX, which is the fear gauge for the market, when the VIX is essentially, 20 or below, then you have what you call a normal market environment. There's not a lot of movement that's expected from the SPX. And so when the SPX makes a 20-point move above or below the opening price, in a quote unquote normal market environment, then oftentimes that's pretty much the majority of the move for that particular trading session. And so if the SPX, for example, were to move 20 points above the opening price, to 59.65, then I'm actually looking to go on the call side, because that's the direction in which the predominant move of the SPX has been made. It has moved 20 points above the opening price. And so I like to get on the call side. Why? Because oftentimes that 20-point move will be the majority of the move before the buyers or the money that's coming into the market actually stops or decreases, right? Causing the SPX to essentially potentially reverse its direction and go back down in value. So I'm looking essentially to get beyond the dog leash, if you will, right? So if the SPX moves to 59.65, then, I'm looking to get on the call side, because if you assume that the price is going to continue to move up and you go on the put side, then what I've seen quite often is that, the under normal quote unquote market conditions, the SPX will reverse its direction and begin to go back down. And oftentimes it'll go back down to the point where, because you assume that it was going to continue to go up, it actually begins to threaten your position on the put side. So I'm always looking to trade in the direction in which the 20-point move has been made. Okay. And so we can see, thus far, the 20-point move has not been made by the SPX as of yet today. And so I'm not looking to trade. Right. But I do have a position on for the May 21st expiration date, in which I put on a few days ago. And so I sold the 60/50, and I bought the 60/55, 5 contracts on the call side and 5 contracts on the put side as well at 58.20 and 58.15. So as you can see here, the short strike has a delta of 3 on the put side, and the short strike on the call side has a delta of 3 as well. So, what we have is a very, the SPX is centered, right, in between my put position and my call position. I got $300 and something for this particular trade. Right, so as you can see here, I'm pretty much at 100%. But then I also have, you see that $755 credit there. I also have a trade on that expires on June the 18th. Now, this is one of my favorite structures or favorite trades to put on, the broken wing butterfly. So why is that? Because the broken wing butterfly actually, it puts that max profit and max loss ratio in your favor. So what do I mean by that? So for example, if I were to look at, let's just say going out, and I always do this, this broken wing butterfly, I always do it for an expiration date that expires 2 weeks or more out, right? So let's just say I'm looking to go to June 3rd, and I'm looking to put on a broken wing butterfly, right, on the put side, let's just say, because the market is bullish, right? Let's just do this here. So as you can see here, if I were to put on a broken wing butterfly, so I would have a long put option here at strike price of 57.85. I would have 2, all right, short strikes that make up the body of the butterfly at 57.80, and then I would essentially, as opposed to going to the next strike price, I would break the wing and actually go, make this a 10 spread and have this continue to be a 5 spread, right? So this here, the bottom portion of the butterfly would actually be broken and would actually have a 10 spread, if you will, or 10 points less than, I'm messing this up. So you would have a 10-point spread here between the body and this part of the wing, and a 5-point spread here between this wing and the body, right? And so because they are asymmetrical, if you will, it's called a broken wing butterfly. So now you can see here that the max profit is actually 570 and the max loss is 430. So the max profit, the ratio of max profit to max loss is actually in your favor as a seller. But oh, by the way, you also still get a credit of $70 here, right? A $70 credit. So, I would do multiple contracts. I would do at least 5 or more, right? So where I'm looking at a max profit of 39.20, max loss of 30.80, and I have a credit of, after commissions and fees of $370.13. Now, what you'll notice is that the profit zone of this trade actually extends beyond this debit portion of the broken wing butterfly here. So essentially, what can actually happen is that the price of SPX, right now is at 59.48.41. What could actually happen by expiration is that the price of SPX can actually drop below these 2 strikes here, and you can actually potentially end up experiencing or realizing a profit of $3,920 or close to it on a day of expiration if the value of SPX is, within this green zone here. And although it has breached these 2 strike prices, as long as it doesn't go beyond this green profit zone, you can potentially realize $3,920. So essentially, this structure, this broken wing butterfly, actually benefits from the price of SPX falling in value. But the bonus is, even if it doesn't fall in value, if it stays above all three strikes of 57.85, 57.80, and 57.70, you're still going to get this this credit here of $370. So it's it gives you, two ways of actually, winning or walking away with money on this particular structure that's called a broken wing butterfly. So it's one of my favorite trades to actually put on. And as I mentioned, I have one for June the 18th. Right. And so that's the reason why you see this large credit here for the SPX. So, and I also been trading the United Health Care as well. I'm sure you guys have heard the news about, United Healthcare. It dropped significantly from, $630 over the last month down to as low as $248. So as you can see here, I'm making money on it. I also have a position on the RUT, the RUT, which is a indice or index that a lot of folks really ignore because they are more focused on the SPX, because the SPX obviously has more liquidity than the RUT. But nonetheless, the RUT is much less volatile than the SPX. And so getting in a trade on the RUT around the 11 o'clock hour, for the most part, is a pretty safe trade, because from that point on, the RUT doesn't move very much. Often, not always, but often it doesn't move very much. So as you can see here, I have a asymmetrical iron condor on the RUT. I got 6 contracts on the call side and 5 on the put side. Right. So as you can see here, the delta is 3 on the short strike, and got a 2 delta here on the short strike on the put side. So, the trade is nicely centered, and we can see here that the overall positions delta is near 0. And that's what you want your delta to be. You want your delta, your positions delta, to be as close to 0 as possible. Also have some other trades on here. I got a put credit spread on Lilly. I got some positions on Datadog, slightly in the red. And then I'm long on A-Lab, right? So I bought call options on A-Lab because I'm expecting A-Lab to really take off. And as you can see here, I'm already up 7.5%, or I got a credit of unrealized profit of $340. So things are going quite well right now. And again, that SPX broken wing butterfly spread is really one of my favorite trades that I like to trade, but I don't do it for the 0 DTE expirations, because you got 3 legs here, right? You got this leg, and this leg, and it can be a challenge getting 3 legs filled for a 0 DTE trade. So I like to go out, 2 weeks or more. I know some folks like to get money every day, or also they don't like the overnight risk. But yeah, I think things have calmed down quite a bit, as we can see here, looking at the VIX, right? The VIX is below 20. And so yeah, I'm not concerned about the overnight risk, So again, if you found some value in this video, please like the video and subscribe as well. Definitely appreciate it.